Hello and welcome to the clients of Escala Partners. My name is Stephen Dickinson, Head of Managed Funds in the Chief Investment Office at Escala. Today I'm joined by Richard Blackburn from CVC. CVC Capital Partners has a long history. Can you discuss the origins of the CVC business and how you would describe the firm today?
Yeah, thanks, Stephen. Of course, the history of CVC really goes back to the start of the private equity industry in the 1980s. We were originally Citicorp Venture Capital, and then we were bought out by our partners in 1993, becoming the private partnership CVC. And with that, we inherited an extensive footprint across Europe. And since then, over the last 40 years or so, the business has been built out substantially across Europe, and then over the last 25 years or so across Asia Pacific.
Globally, CVC is one of the largest private equity investors. Can you discuss some of the key differentiators of your business versus the peers?
Yeah, of course. Today, CVC is a global private equity firm managing about 200 billion euros of AUM, and we're really focused on Europe, and we have an absolute commitment to high performance. I'd say in terms of our investment style, we're firstly conservative in nature. We look first to protect our investors' capital, but then we are also very ambitious in how we go about things. The combination has allowed us to consistently deliver industry-leading returns over the full length of our fund cycles. And really, in terms of the points of difference that have led to that performance trajectory, there are a couple I highlight. Well, first is really the network and people. We are a hyper-local business. We have teams of local nationals in market across 30 offices, which provides us the best insights and relationships and deal opportunities. And we combine that with a very long tenured group of deal leaders. So most of the managing partners have been with the business, investing with the business for 15 to 20 years across multiple cycles. The second point is the unique culture and reward structure that we have. The culture is based on being entrepreneurial, performance driven, and also very long-term focused in nature. And it is worth emphasizing that is coming through again through our incentive structure, which is unique. So most private equity funds will operate with a fund level carry system where rewards are based on the average as a result of the institutional funds raised and the performance of those. It's quite different within CVC. We have carry awards that are directly linked to the investments that individuals make, which is a critical element of aligning the deal teams with the investors. And it means that we need to be very entrepreneurial and proactive to make investments. If we don't make investments as deal leads, we don't get paid. But we also need to be very balanced and honest in our investment judgment, because if you make a poor investment, you have to recover that value before you can benefit from the positive carry on other deals. So they're really the two key features, and they flow through into the firm benefiting from a deep origination funnel where we're very active in the market. We see more opportunities, and that allows the firm to be highly selective and ultimately get greater diversification within the portfolio. So putting those together, I think, is really where we build our point of difference.
CVC has a wide employee ownership model. Can you discuss the depth of the team, how the team is organised, particularly by sector and region?
But back to this point on the entrepreneurial culture, the ownership mindset is very important within CVC. So you're right to highlight that. CVC has been a public company since 2024, but we remain 70% owned by our employees. So there's very direct, deep employee ownership. And in addition to that, we have the further exposure to ownership through the deal-by-deal carry structure that I discussed. So that is at the heart of how we drive performance. In terms of the team, we have 560 thereabouts private equity professionals across our 30 country offices, and they're supported by 5 specialist industry groups. So these are across financial services, healthcare, sports and entertainment, technology, and aviation, defense, and space. And so we end up with 35 entrepreneurial business units led by nearly 100 individual deal leaders that are out in the market creating investment opportunities. And that activity is what delivers the wide funnel and the deep origination funnel that I spoke about earlier.
CVC Private Equity maintains a global orientation with that emphasis on European exposure. What makes Europe attractive geographic market for CVC to deploy capital?
The European private equity market, firstly, is a very attractive market. The returns are strong and they're in line with the US market over the last 10 years and indeed over longer periods of time. We've studied this quite closely, and we think the mix in the source of those returns is quite interesting. So within the US, most of the market return in private equity comes from beta, the market elements of business performance, whilst in Europe, the private equity returns at a market level are coming 50% from beta, the market, and 50% from alpha, the more operational, proactive outperformance of the manager. And what we see is this means that the returns in Europe are more controllable. CVC is able to drive, therefore, consistent returns through the processes it has around driving alpha into its portfolio. And in addition to consistent returns, we're also able to drive outperformance through some of those levers of differentiation we've spoken about. So we, over the last 10 years, have achieved 2 times the level of alpha in our portfolio compared to the European market. So we do see it a very attractive place for us to be investing.
How important is having long-standing on-the-ground teams across Europe when sourcing and managing investments?
Well, that is absolutely critical to how we go about our business. As I mentioned, we have people in 30 offices around the world. The majority of those offices are across Europe, about 16 of those offices are across Europe. And whilst most firms will have offices in major cities, perhaps London or Frankfurt, etc., it's really the less obvious locations, the smaller geographies, for example, Poland and Denmark, where we have local teams. We don't have expats. Those teams speak the language, they know the businesses, they know the governments, the families. They can originate truly unique investment opportunities. And we've seen that play through time and time again over the years. To give you a couple of examples, we acquired the electricity company for the railways of Poland, which we bought from the government. We institutionalized and professionalized that before selling it back to the government, making 4 times money return. In Poland, again, we bought a convenience store chain called Żabka, which was a brilliant business. We changed how the business was ran in taking the management team to Silicon Valley. We introduced them to all of the tech companies, and we brought AI in very early to a convenience store chain and ended up with 10 times our money on that deal. And then turning to Denmark, we invested in the post office business in Denmark in a 50-50 deal alongside the government, where we worked to modernize and professionalize that business before, again, being recommended by the Danish government to the Belgian government to do a similar thing. So these are just examples of unique investment opportunities that we're able to unlock, to your question, because we are very embedded on the ground in these markets, and those are deals that weren't available to others.
What do investors often underestimate or misunderstand about investing in Europe compared with the US?
I think really there's 2 things. Firstly, the level of opportunity, but also the level of complexity that results from fragmentation of the European market. So the US market is one market, one language, one legal system. It's very efficient. We see lots of auctions, highly competitive processes, typically high prices. Whereas the European fragmentation creates inefficiencies, which really the network we have can feed off. And that leads to different types of deals for us. So 97% of CVC's deals are sourced in bilateral or limited processes. And we're able to get unique access, as I spoke about, in some of those countries, but also through partnership investing with founders. And really, I think what is misunderstood is the barriers to entry within Europe, but the ability to unlock those if you really are local on the ground with the right talent and teams.
What are some of the typical characteristics that CVC look for us to qualify for investment? What industries do you tend to invest in, and why, and how, from an investment philosophy point of view, do you look to add value to these businesses?
Firstly, we're really looking for high quality, market leading businesses with strong management, and in particular where we see the ability to accelerate growth and the development of the business. We're across sectors. I mentioned some of our sector teams. We're investing across sectors. We don't take top down macro allocation in our portfolio construction. It is very much built bottom up based on this network of local teams seeking out the best opportunities, creating a deep funnel, and then that being picked through selectively by the investment committee. In terms of our portfolio, we're quite cautious in our underwriting style. So when we look at the mix and the makeup of our returns, it's typical that about 2/3 of our investments deliver as we would have expected in terms of the underwrite of returns. But in 1/3 of cases, we get quite significant outperformance deals where we're making between 5 and 10 times our money. And that's really based on the same underwriting approach that we take across the board. We're not taking more risk, but we're typically getting more traction in the value creation plan that we've developed for that business. And you asked how do we work with the businesses and how do we add value? We firstly work through the CEOs. We're looking to form a partnership with the CEO, work closely with the CEO. That's a very important appointment. We're then developing a very specific plan for each business, and we're working with that business all the way through to exit. And we're thinking about exit from the start. And of course, exit has been a very topical aspect within private equity over recent years, and our consistent approach to planning for exits and working with the management through exits has enabled us to consistently deliver money back to our investors.
Can you give a flavour of the size and quality of companies that CVC is looking to invest?
Well, when we consider the funds we're investing, so if we look at the flagship Europe and Americas buyout fund, that's a 26 billion euro equity fund. We're currently investing that, and we would typically be writing individual equity investments between around 500 million euros and 1 billion euros into each investment. So these are large, established, high-quality companies. But important to say, we're really operating at the upper to large mid-market space rather than the mega buyout space. And that's important and an important part of our strategy. It means that we end up with a more diversified portfolio, but also allows us to really focus on that alpha value creation rather than businesses that are so big they more follow the market.
On an average year, how many opportunities would CVC's investment team review, and what percentage would proceed to investment?
In terms of the new deals and how we think about reviewing those, if I look to the latest fund, Fund 8 within Europe, that is fully invested. Across that fund over a 4-year period, we reviewed about 380 individual investments and 37 investments proceeded through. So if we consider that over 4 years, we're really looking at around 100 investments a year with about 10% moving through to being within the portfolio. I'd say that is quite different. A typical large cap fund would perhaps end up with 25 larger, more concentrated investments within the portfolio. Within the CVC flagship buyout fund, we would expect to end up with more like 35 investments. That really comes back to that point of being a large mid-cap investor. And it also reflects the fact that we are, through our broad networks, coming across some really interesting entrepreneurial businesses. They may be a bit smaller. For example, we invested in the Global Volleyball League. We invested in the Women's Tennis Association. Both really interesting businesses, great investments that are performing very well. But the investment around those was a much lower check, around 100 million euros. So as a result of that, we end up with this broader, wider funnel.
Could you share an example of a portfolio company that helps illustrate how CVC invests and also creates value?
I think a really good example of that is the Formula One investment that we made. We've been actively investing across the sports space for some time now. It started back in 1998 when we invested in MotoGP, the motorbike racing competition. And it led from there into a bilateral deal opportunity that was led by one of our founders, Donald McKenzie, partnering with Bernie Eccleston to unlock a really interesting deal around Formula One. That was a very complex situation. We were able to acquire the business at an attractive entry multiple because of the position and relationship we were able to build. But there were risks in that situation, including at the time the potential for teams to break away from the competition that had been formed. And so the strategy we developed, which is typical of how we think about these things, was to come up with a growth plan for the business. We first expanded the business into adjacent areas. We acquired hospitality, trackside advertising, the Formula 3000 competition, and also invested into technology and expanded the number of races. So really, we increased the profit pool, the sales side of the business, such that we could reinvest those profits back into the team profit share to secure the long-term future of the sport. So we both look to grow as well as increase the quality and resilience for the long term of the business. And then we were able to identify Liberty Media as the right next owner, whereby we felt they brought specific opportunities for the business within the US and obviously with deep media expertise. And so that ended up being a very successful investment for CVC. We made around $6 billion in gain, around 7 times multiple of our money. But importantly, we also achieved a good long-term ownership structure for the business, and pleased to see the business has gone on to perform very well.
From an investor expectation point of view, what does success look like for an investor in CVC private equity over the longer term?
The success that we're looking to provide to wealth investors is really accessing the opportunity through the evergreen structures for the CVC and broader PE returns to become available for wealth investors. Until this point, really, the private equity investment has largely been for institutional investors, very large tickets.
Just on that, when we think about this product we're focused on, how does this differ from traditional closed-end private equity funds that investors may already be familiar with?
Yeah, so it's a very important point. Closed-end funds are typically, as people will no doubt know, 10-year funds where capital is committed up front. It's invested for a roughly 4 to 5 year period, and then assets are sold and capital returned over the subsequent 4 to 5 years. Typically, as I say, available for larger institutional investors. The CVC PE product is an evergreen fund, and it's a direct co-investment strategy. So the fund takes individual positions, typically across each of CVC's private equity investments in the 5 relevant strategies that make up the CVC PE product. And when those individual investments, co-investments are realized, the capital is recycled within the fund to invest in the next opportunity, with really the focus of the CVC PE product being long-term NAV growth. And importantly, I'd say this opportunity is now available, as I say, to wealth clients with an opening initial investment, which is much lower, around $50,000 or so.
In terms of the portfolio construct today, what does the portfolio look like in terms of how many companies does this product invest in? How is the portfolio diversified geographically, and where is the majority of capital currently allocated?
So the fund has been available for around 6 months or so now. The strategy is currently invested in 114 companies across 7 sectors. And within that, there are multiple vintages of investments represented from 2018 through to the most recent investments that CVC is making. And that's really because as we set out this portfolio and set up the portfolio, there was a seed element that comprised some of CVC's best investments from existing funds, which were moved into the CVC PE portfolio. But as we move forward, as I say, it's a co-investment, direct co-investment strategy. So a portion of each new investment will find its way through to the CVC PE product. When we look at the mix today, about 60% of the portfolio is Europe, 28% Americas, and 12% APAC and the rest of the world. So it's very much reflecting the strength of the Europe and America's flagship buyout fund, which is skewed towards European exposure, and that will continue. And as we go forward, we'd expect the top 10 investments to represent around 35 to 45% of the portfolio, with then a tail of smaller investments, each between 1% and 3% of the fund.
And just on the portfolio side of things, this product, the CVC Private Equity Fund, offers periodic liquidity. How should investors think about access to capital compared with listed investments?
Yeah, so that's correct. There's some liquidity available. So the local CVC PE feeder in Australia offers monthly applications and monthly redemptions, which are netted against a quarterly 5% cap on redemptions at the master fund level. So there is liquidity available. The main benefit of the evergreen funds really, though, is access more so than liquidity. Access to these CVC PE returns and investment opportunities is really what we're offering. Liquidity is there, but investors should really view this private markets investment as a long-term position where really the benefits accrue through the compounding effect of the NAV over time.
And finally, if listeners take away one key message about CVC private equity after this conversation, what would you want it to be?
I think really the key message is that CVC is a globally leading private equity firm, but really we are the European firm. We're built for high performance at its core, and that comes from our hyperlocal network, the talent, which is very long-serving and stable within the business, and our entrepreneurial culture, which is reinforced through our unique incentive model. And so clients should consider this product for their portfolio to access globally leading PE returns and PE returns that are driven through Europe.
Richard, thank you very much for your time today. I think we've gained some very topical insights into the global private equity opportunities that CVC is currently seeing. I hope everyone enjoyed the update, and we look forward to sharing further information with you going forward.
Thank you for listening to Escala Partners Perspectives podcast. Be sure to subscribe to this podcast on iTunes. Escala Partners is a corporate authorized representative of Escala Wealth Management, which holds its own AFSL. This podcast has been prepared without consideration of specific client investment objectives, financial situation, or needs, and is for general information purposes only. Please don't rely on it for the purpose of making an investment decision. You should seek independent financial and taxation advice prior to making any investment decisions in relation to any of the content considered in the podcast, and consider any relevant disclosure documents. If you require any further information regarding the matters discussed on the podcast, please contact Escala Partners.